IFRS 16 leases, initial measurement of the lease liability in the books of the lessee. The lease liability is measured at commencement date at the present value of the future payments not yet paid at commencement date. In order for you to calculate that present value, you need certain variables. We have already looked at the payment variable, the future value variable, and the lease term variable. What we still need is the interest rate that we will use to discount all these future payments by the lessee back to your present value. This presentation will now focus on determining the interest rate necessary in this calculation. Paragraph 26 of IFRS 16 reads as follows. At commencement date, a lessee shall measure the lease liability at the present value of the lease payments that are not paid at that date. The lease payments shall be discounted using the interest rate implicit in the lease, if that rate can be readily determined. If that rate cannot be readily determined, the lessee shall use the lessee's incremental borrowing rate. So this paragraph tells me I need a PV, and to get a PV I need an interest rate. And it tells me specifically the rate I use, and it's given in italics as a term, interest rate implicit in the lease. But what's important to note in this paragraph is that there is a possibility that that interest rate implicit in the lease cannot be calculated by the lessee. And then it's okay. Then the lessee will use its own incremental borrowing rate. This is an extract from Appendix A to IFRS 16. In paragraph 26, we saw the term interest rate implicit in the lease as italic. Whenever you see that in your IFRS standards, you know there's a definition following in Appendix A. So this definition will now give us the necessary guidance on how to calculate interest rate implicit in the lease. So that means my interest rate variable is the unknown at this point in time. This paragraph will give me the necessary guidance to determine the other variables. It says that it's the interest rate that causes the present value for the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct costs of the lessor. First of all, you need to note that this paragraph refers to the unguaranteed residual value and the initial direct costs of the lessor. Both those terms relate to the lessor only. It is not something that the lessee will have to do anything with. That tells you that your interest rate implicit in the lease is calculated from the perspective of the lessor. It is the expected rate of return that the lessor wants to earn on this lease agreement. So let's unpack those variables. You will have a payment variable, and that would be all the payments that the lessee will have to make over the course of the lease term. N would be your lease term based on the same principles we've discussed before. The future value variable would, however, be the final amount that the lessee has to pay, either as a balloon payment or under a residual value guarantee, plus the unguaranteed residual value. So it's the total return that the lessor expects at the end of the lease term. It's what he gets back from the lessee, as well as what he could possibly earn from selling the asset to a third party through this unguaranteed residual value. Then you need a present value variable. And the present value variable is from the perspective of the lessor, the total amount that's being financed. And that will be the fair value of the underlying asset, because that's the asset that is being financed, together with the initial direct costs incurred by the lessor. So your present value represents the total value for the lessor that's being financed. And then your payment and future value variables will be everything that the lessor expects to get back. On that, he needs a proper rate of return through interest, and that is how you will calculate your interest rate implicit in the lease. Example 8 looks at determining the interest rate variable. Poly Limited, the lessee, entered into a 5-year non-cancelable lease agreement with Kiki, the lessor, to lease a piece of equipment. Ownership of the equipment will not transfer to Poly Limited at the end of the lease term, and the contract is a lease per IFRS 16. We have a 1 January 2015 commencement date, annual lease payments of R100,000. The lessee incurred initial direct cost of R1,500. The lessor incurred initial direct cost of R5,000. And we have a residual value guarantee of R40,000. If the fair value of the piece of equipment at the end of the lease term is less than this R40,000, Poly will pay as part of a final payment an amount equal to the difference between the fair value of the piece of equipment and this R40,000 residual value guarantee. On commencement date, Poly Limited estimated that the fair value of the piece of equipment would be R34,000 at the end of the lease term. Because the lessee has to calculate the present value at commencement date you already have to estimate your expected future payment under the residual value guarantee. The incremental borrowing rate of Poly is 12%, and the fair value of the piece of equipment on commencement date is R400,000. When determining the interest rate variable, you have two possible scenarios. Scenario 1 looks at the situation where the lessee has knowledge of all the information provided above. Then, as step 1, the lessee will be able to calculate the interest rate implicit in the lease by definition. Your present value variable represents the total amount that the lessor wants to finance through this lease agreement. It constitutes the R400,000 fair value of the underlying asset at commencement date, plus any initial direct costs incurred by the lessor. The R405,000 together is the amount that the lessor wants to finance in this agreement. Your lease term variable is determined in line with previous guidance, and it's the non-cancelable period of 5 years. The payment variable is the R100,000 payable by the lessee annually in arrears. The future value variable represents the expected return by the lessor at the end of the lease term. In terms of this agreement, there is a residual value guarantee of R40,000. The estimated future fair value of the asset is R34,000. So the expected return by the lessor is R6,000 from the lessee as a final payment, as well as an asset that's worth R34,000 at the end of the lease term. So the total residual value guarantee amount is the future value variable from the lessor's perspective. These variables will now give you the interest rate implicit in the lease of 9%. 6.9%. Step 2 under scenario 1 would now be to calculate the amount at which the lease liability would initially be measured. So we have to now calculate the present value of this lease liability. Your variables will be as follows. You have the same N as what we've used in step 1, being the non-cancelable period, the same payment as 100,000 Rand payable annually in arrears. Now you have to use the interest rate that you've just calculated above in step 1 as your interest rate variable, being the interest rate implicit in the lease. Your future value from the perspective of the lessee is only 6,000 Rand, being the difference between the residual value guarantee of 40,000 and the estimated future fair value of the underlying asset. The future value from the perspective of the lessee is the final amount expected to be payable. This then gives you your present value of the lease liability. Please note under step 2, the variables is from the perspective of the lessee. Scenario 2 looks at the situation where the lessee does not have knowledge of all the information provided above. That includes information on something like the initial direct cost incurred by the lessor, or perhaps the unguaranteed residual value. Then, as part of step 1, you will not be able to calculate the interest rate implicit in the lease by definition. But paragraph 26 then allows the lessee to use its own incremental borrowing rate. When the lessee now has to calculate the present value of the lease liability, the variables will be as follows. Again, your N variable is the non-cancelable period. Payment variable is the 100,000 Rand payable annually in arrears. Your future value is the same 6,000 Rand that we've discussed above. But now your interest rate that you will use will be the interest rate, the lessee's incremental borrowing rate. And this rate will usually be given in a question. So when you calculate the interest rate variable, you have to determine whether you have all the information available. When you do, you have to calculate the interest rate implicit in the lease. If that's not determinable, you can revert back to the lessee's incremental borrowing rate.